With the concerns over the debt levels for Kenya being raised, this is a conversation that we need to have, and that's why we have in studio Dr. Geoffrey Mwau. He is the Economic Secretary at the National Treasury, and apologies that Kwame Owino, an independent economist, could not join us this evening. He was meant to join us and his thoughts would have been welcome. But first, on one side, it seems like a celebration on the money that we have raised through this latest Eurobond, 200 billion shillings. But on the other side, on the same day, it is being communicated that we are in the red in terms of our debt levels, and this is from the International Monetary Fund. Is this the best time to be borrowing more money?
Well, yes, as you've said, it's a time to celebrate, but also others are worried about it. I think let me start by pointing out that what we are borrowing today is already factored in our budget policy statement that was approved by Parliament last June, and it was based on analysis of debt sustainability. And it showed that even with that borrowing, which amounts to about 250 billion in total, our debt position will still remain sustainable.
Right.
So we are within that limit of our borrowing. And even the IMF did not say that we're in the red. They are saying that if we continue borrowing,
which we have in borrowing.
No, I will point out that if we continue borrowing more, we will now get to a point where we are in a
So are you saying
position.
what the IMF is stating is if we borrow now moving forward, that we are in the safe region or margin right now? Where are we in terms of
We have to
our debt
always
levels?
be informed by the analysis of debt sustainability to remain within the acceptable thresholds that we have. And Kenya is very much within those
Where are we now?
thresholds. We're at about 51% in net present value terms. And the threshold for a red light is 74%. But we don't want to go there because we want to leave enough room for us to be able to weather any storm that comes along the way.
Right.
Now, what the IMF is saying is that if we continue that way, but if you look at our budget policy statement again this year, we have shown a lowering of the deficit from 9.1% last year. This year it is going to be about 7.2%. Next year, 6%. The year after that, 4.3%. In other words, we are reducing the deficit, and that means that our borrowing will be less. The other thing, if you'd allow, we don't just measure debt in gross terms, because since 2012, I saw ISPAC saying that debt has increased. Our GDP has also multiplied. So if you look at that debt as a ratio of GDP, it is very comparable.
But our KRA revenues, at least the rates at which it's growing, isn't so much in tandem with the appetite that we have for borrowing. So in simplistic terms, we wouldn't look like we are able to pay back comfortably, or we are in a place where we can comfortably ask for more money.
Well, let me point out again that even when we are facing shortfalls in revenue at KRA, we don't borrow because of that. We adjust expenditures. This fiscal year, based on the challenges that we had with elections, drought, and other shocks, we were able to rationalize our budget by cutting expenditures in ministries by almost 75%. So you usually, first of all, look at the expenditures and rationalize them so that you're able to spend what you have. Yeah, so we still remain within the permitted debt limits that were approved by Parliament.
Would you foresee, again, cutting expenditures just to be in a safe regional margin, just as has been the case, as you've mentioned, to be able to sustain or be able to pay back what we are borrowing now?
Okay, let me also point out that like last year, 2016-17, the deficit was high because of one-off expenditures related to elections, mainly, but also to the drought that afflicted the country up to a point where we had to provide food to more Kenyans than we usually do. And if you recall, the election law was amended, and again, it added more costs. That's why the deficit was so high. Those are one time of expenditures. They are going to now not appear this time around, maybe 5 years later down the line. Again, the repeat elections also added more spending. We were projecting about 6.2% deficit. It went up 1 percentage point to 7.2. Next year, it's going to 6%. So in terms of spending, what we are projecting now in the next 3 years will bring down the deficit down from 6% next year to 3% in 3 years' time.
Right. And even with the news that we are having right now, because you've mentioned the drought situation, and it is still, we've seen the appeal there earlier from Red Cross, that things are not getting any better if the rains are still continue to fail us. So you don't see any cause for concern?
Well, we already in the budget, we have factored funds for contingent funds for drought and other emergencies. So already we have some buffer there in the budget already.
All right.
Now, if that is not enough, then we will have to look for other measures to...
Other measures being more boring?
No, maybe reallocating the budget and this is not the first time we are doing that.
Okay.
We have done that many times in the past.
Okay. How much of this current Eurobond will go to paying the first batch of the previous 2014 Eurobond? I'm told in 2018 we should be paying around 700 million to 1 trillion. In terms of the paying back of that first batch?
First of all, before I give you the numbers, although I think you are right, let me point out again that, this talk that you are borrowing to repay, it is standard practice in international capital markets to undertake what you call liability management. That is, you are trying to rebalance your liquidity availability with your liabilities. Banks do it. International institutions do it, countries do it. It is not just Kenya.
So effectively what you're saying is not, you haven't borrowed to pay what is maturing.
No, it is
in terms
standard
of what is
practice.
What you'd be expected to pay next year.
It is standard practice, and I will tell you why. Sometimes when a bond is nearing maturity, it loses liquidity. And most countries, what they do, they actually go and when they go to the market again, they refinance that one to get a longer term bond. And if you look at what we have done, we have gotten a 10-year bond and a 30-year bond. Now, how many countries in Africa can get a 30-year bond? That shows you what investors think about the robustness of the Kenyan economy.
You've mentioned something interesting there, what the investors think. However, the interesting bit and fact about it is that the interest rates are very attractive. So it's not so much, someone would say, it's not only the fact that Kenya would seem as an attractive destination to invest in, but as well as the very attractive and lucrative interest rates that in their markets are just mind-blowing.
Well, again, let me point out or clarify that. First of all, the fair value for a 30-year bond in sub-Saharan Africa is 8.5. We managed to get 8.25. Now, when we started pricing early yesterday morning, we started at 8.6. And because of this appetite of our investors, a broadened base of investors from all over the world, we were able to bring it down from 8.6 to 8.25 for the 30-year. For the 10-year, we brought it from 7.6 to 7.25. So again, it shows you where Kenya is in terms of being able to command good prices for our bonds in the international capital markets.
Right. And of course, a lot of this is going into the infrastructure projects that we have.
And other development priorities, but mainly infrastructure. And here we are talking about roads, energy. We are talking about...
As it seems, it's difficult now to be able to start plowing back what we invested in the SGR.
Not really. I mean, we are still in very early stages of getting the SGR fully operational. We have just completed the inland container terminal. We need to improve on some of the logistics to be able now to move cargo seamlessly right from the port in Mombasa to the inland container terminal in...
But not to force people to go via the railway. They can choose from road or railway.
Yeah.
The final question, would you consider offering a tap sale given the oversubscription, sevenfold oversubscription of this Eurobond?
Again, it depends on market conditions. If the market conditions are right, and again, that's where we're talking about liability management. If market conditions are fine, you can consider that. But for example, if you look at what happened in January, market conditions were not good at all. You saw what happened in the stock exchange in New York. Then from our own timing now, the timing right now was perfect for us because we were able to get a better deal. Okay. Because the market sentiments have changed and they are now in our favor.
All right, from the Treasury's perspective, the timing is perfect. Concerns are being raised about our debt levels, and this is a conversation that needs more time. Definitely will be able to lend more thought on this from independent economists and other players in this industry. Thank you, Dr. Geoffrey Mwau, for your time and thoughts on this. And